This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, March 9, 2016, featuring Update Analytics, incorporating data from the Update Energy Feed, the Energy Information Administration, Baker Hughes, and CME Group NYMEX. Highlights from this week's report: production remained stable while we set a new century low total rig count. Commercial crude oil added approximately 3.9 million barrels to storage, setting a new record. Total petroleum, diesel fuel, and gasoline all experienced a small drawdown, and the products and crude oil are all trading in short-term positive trends and targets. Let's go to the charts. Beginning with continental production, this is the lower 48 United States. Production is stable this week at 8.6 million barrels per day, still slightly below last year's minimum and still well below the 52-week moving average, which has now begun to slope downward ever so slightly. U.S. field production includes Alaska production in addition to the lower 48, stable this week at 9.1 million barrels per day, also below its 52-week moving average, which appears to be sloping downward slightly. Commercial crude oil does not include the Strategic Petroleum Reserve. In the bottom pane, you can see the 3.88 million barrels added to storage, and in the top pane, you see the new all-time record of 521.9 million barrels in storage. The seasonal comparison charts we build for crude oil and the two refined products. In the top pane, we have the last 12 to 14 months of storage data. The silver dashed line is the 10-year average of storage. Take the delta between the two and plot that as a bar graph in the bottom pane to show either a surplus or deficit relative to the 10-year average. And in this case, we have 197 million barrel surplus, a new record for commercial crude oil. Cushing, Oklahoma is the physical delivery point for NYMEX light sweet crude oil futures. It sets a new record this week at approximately 67 million barrels in storage. Total petroleum storage is commercial crude oil plus the 12 refined products tracked by EIA. This is something we talk about nearly every week, setting a new record. However, this week we do have a very small drawdown in total petroleum storage, so no new record. Exploration and production activity is measured by the Baker Hughes rotary rig counts. This particular rig count is the U.S. oil rig count, so this is solely the United States, down to 392 after stacking out 8 rigs last week. We drew the brown horizontal line across to intersect previous activity, and in this case it intersects in December of 2009, was the last time we had this little activity in upstream oil exploration and production. The total rig count, this is the land rig count we mentioned at the top of the report. It's down to 463, so this includes all rotary rigs exploring for oil and natural gas in North America. And we take that 463 and follow the horizontal line. We come across to July 2nd, 1999, so this is a century low for exploration and production activity, and if the trend continues, it's not hard to imagine that we'll descend down to 392 or below that and set a new all-time low activity record for upstream oil and gas exploration and production. Over to the pricing report. This is the seasonality chart. In the top pane from the Update Energy Feed, we have the continuous NYMEX light sweet crude oil futures, so this is roll adjusted to account for the slope of the forward curve. And in the bottom pane, we have the 10-year weighted average of annual seasonality, and that emphasizes the more recent years. When comparing the two of them, you see that from this point forward, we continue with seasonal strength up till the end of April or May, and then we go sideways before the seasonal trend turns negative. Over to the daily cloud chart. We look at this each week, and this is definitely more bullish than it has been in previous weeks. The things that we look at here, first of all, is that we have the price. The red and white candlestick chart is trading above the cloud spans. The cloud spans have reversed positive. That's the light blue area there just to the right. The turning line is above the standard line, and price is trading above the turning line. The one thing we are missing that would turn this into a confirmed positive trend is the heavy blue lagging line needs to move through the upper cloud span, and right now that would take a move upward somewhere around 40. Very important, though, to go back. We do have an area to compare. If we go back to last year and we look here March, April time frame, we had a very similar situation where the price moved up through the cloud and then the lagging line followed sometime later as that seasonal strength was helping drive prices higher. Once the seasonal strength dissipated, prices moved sideways and the downtrend resumed. It'll be interesting to see if that occurs similarly this year. We're in a situation where production is lower than we were this time last year, but storage is much higher. So we'll definitely keep an eye on how that plays out. But for right now, the daily trend is showing positive signs. On your updated system, if you go Shift-T, that'll draw a 3-box reversal chart, or however you've chosen to save your point and figure charts. For this example, I've drawn a 1% 3-box reversal, and it puts in the automatic trends and targets. Some difference we see here on this is that we're still well below this bearish resistance line, and it would take moves well up into the 40s or 50s to reverse this trend, and that's another reason that would make us somewhat skeptical of being very aggressive calling a long-term trend change. As far as targets available, we've got one positive upside target to 41.32, and then one very extended downside target down to 15.5 off this previous thrust from last summer. Moving to a shorter term time frame, we mentioned this at the top of the report. This is the 60-minute point and figure chart. This is 10 cents per box on a 3-box reversal. You can see the same horizontal line here, approximately $34.30, that provided some resistance. We broke above that and continue to work above this bullish support and these intermediate trend lines we continue to add. Only one active upside target to $39.70. We realized all the others, and no active downside targets at this time frame. Over the actual futures, this is CLJ6, so this is April light sweet crude oil futures. When the report dropped this morning, we were right here about 37.25, got all the way up to 38, and now we're descending some into the close right now. You can see that positive trend all the way from the end of February back up here, albeit with some volatility. We always take a look at dollar correlation. To do that, in the top pane, we put NYMEX light sweet crude oil futures. The next pane, the heavy green dash line, is the DX dollar index that trades on ICE. Then we use Updata Analytics to measure the all-time correlation between those two instruments and plot that as the heavy blue dash line. Consistent with an internationally fungible dollar-denominated commodity, it is an inverse relationship with a -80. In the bottom pane, the heavy brown line, what that measures is the correlation just over the last 65 days. So this gives you approximately 3 months worth of correlation. This did get it to a positive correlation up as high as 50, and now it's beginning to correct back toward its historical negative relationship. And if we zoom in, you can see the reason that had become so positive was here around the middle of February, that as crude oil trended up, the dollar index was trending up. But then beginning here in about the last week, the dollar index has fallen from over 98 down to 97, while crude oil has continued to increase with that positive seasonal trend. The forward curve of NYMEX light sweet crude oil futures, this is from the Update Energy feed. If we go back and look 5 days ago, the one thing that's kind of interesting here is that the curve is actually flattened out, that we've actually descended somewhat here in the out years, out into the 2020s. That indicates that the market seems to be thinking there's going to be ample supply out there at that point, which is interesting given the extremely depressed rig counts. ULS diesel had a small drawdown this week. We mentioned that. Still haven't threatened the all-time record, although we are close to it. The seasonal comparison, the one change we do make for diesel fuel is the blue dashed line is a 5-year average, since it's a newer product. Taking the delta between storage and its 5-year average, we've got approximately 38.4 million barrel surplus for diesel fuel. The seasonality chart for diesel fuel somewhat mirrors what we saw for crude oil. Beginning the end of January, we get this positive seasonal strength. We do enter some volatility here in March, and then a little bit more seasonal strength into April before it moves sideways and declines. So we are in a time of some seasonal strength, but that's beginning to end. The daily cloud chart for diesel fuel, not unlike what we saw with crude oil, beginning to show some positive signs. We do have the price above the cloud spans. The cloud spans have reversed positive, turning lines above the standard line. But the one thing we are still missing, same as what we were missing on the crude oil chart, is the heavy blue lagging line. Needs to get through the cloud spans before we can confirm a new uptrend, and that looks like we'd have to see $1.30 to $1.35 before that occurs. Shift T for the trends and targets, still well below bearish resistance on a 1% box size. Two upside targets to $1.28 and $1.25. So those both indicate some bullishness, but again, still a long way to go before we would show a trend change at the 1% box size on the point and figure chart. Moving to the shorter term chart, this is the 60-minute three-box reversal chart, and just like we talked about at the top of the hour and what we saw with crude oil, we were butting up against this $1.11 resistance. Once we broke above that, we've made it all the way up to $1.23, realizing that positive upside target. No active downside targets, and one active upside target up here to $1.32, and still trading above bullish support at this time frame. We're the actual futures, HOJ6, so this is April ultra low sulfur diesel fuel, and just like crude oil, you can see the positive trend and the breakout. This morning around 9:30 we were at $1.22, and we've pretty much just corrected right back to it. So very muted trading in diesel fuel. The one-to-one crack spread, this is merely a financial measure of the value of the input, NYMEX light sweet crude oil futures, and then the refined product ULS diesel futures. And that just take that in a one-to-one ratio, and we're up to just over $13.50 after coming down here earlier in the year and being at $8. But we still have a long way to go to get back up here to the $20 range we experienced a lot in 2015. So this could potentially impact some refiner profitability. The forward curve for ULS diesel, go back 5 days ago, and similar to crude oil, we've moved up here at the near, but once we get into the out years out here to 2019, it's actually begun to flatten out. Gasoline still working off. This is our third week in a row. We've had a drawdown from gasoline working off that all-time record, but still well above the 2015 record there of 243 million barrels. The seasonal comparison, what we do in gasoline is we go back to a 10-year average. That's the light blue dash line, and you can see that as we've had these drawdowns the past 3 weeks, that the surplus in gasoline has been worked off slightly, now down to about 24 million barrels. Seasonality for gasoline, the positive seasonality really tends to end more right about now. From here forward, we should see some sideways movement for seasonality, but it's very clear here that once we picked up the positive seasonal trend, we had this nice move up. We'll talk about this a little bit more on the daily chart, but these gaps you see in here are the rolls that took place. This chart is not roll adjusted, and these are the rolls that took place during this time of year, and we'll see more of that on the curve. The daily cloud chart, this is the most bullish of all of them. Very interesting too. This is a similar story to what happened last year, but in this case you can see price is above the cloud span, the blue lagging line is above the cloud span, the turning line above the standard line, and we do have the positive cloud reversal. So pretty much everything we would look at a glance on these cloud charts is positive for gasoline. Just one thing that's very important to note, if we go back here exactly this time last year, the first part of March, we had the same situation. Gasoline broke above the cloud, corrected some, the lagging line broke through the cloud, and then consistent with that seasonality that we saw in NYMEX light sweet crude oil futures, moved sideways, broke back down into a negative trend and stayed there literally until just a couple of days ago. So we will keep an eye on that as to whether this is just a temporary state of affairs dealing with seasonality or if it's a meaningful trend change. Go back to that and Shift T. That draws our three-box reversal. You can see on the point and figure chart, even with that big gap up from the roll, we're still below bearish resistance and no active upside or downside targets right now. The 60-minute chart, we've talked about this where we had this big move up as a result of the roll, and fortunately though for gasoline, if you are long gasoline, this has moved up nicely from there. no active upside targets, and one downside target to 85 cents left over here from last year. But for right now, no active upside targets. The actual futures, you can see the similar situation we've looked at before. This is XRB J6 gradually working higher highs. Each time we would break out sideways, break out again. Then once we got above this $1.35 level, it's been pretty robust since then. This is the one-to-one crack spread for gasoline. This is actually a little bit more actively monitored than the one for diesel fuel. Historically, going back all the way into 2013 and well back before that, you can see we tend to work on a range with a high of 30 and a low of $7.50, and we are seeing some nice move up in the crack spread, so this means an increased gross profit margin for refiners. And finally, to the forward curve for gasoline. Give it a second here to request the data. May just be taking a minute. This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, March 9th, 2016. If you have questions or comments, please feel free to contact me directly. If you'd like to learn more about Update Analytics or the Update Energy feed, please contact their sales team directly. Thank you and have a good day.